Thank you for joining our investment webinar today, Fleeting Opportunities, Two Things to Do in Your Portfolio Now. My name is Sammy Azzouz. I'm the president and CEO of Heritage Financial, a Boston-based wealth management firm managing over $2.3 billion for individual investors and families. Our team of 43 professionals helps people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning in an independent and fiduciary model. Outside of my leadership responsibilities here at the firm, I serve on our investment committee and work closely with a select group of clients and enjoy building relationships with prospective clients who fit the firm's approach. As a follow-up to this webinar, you'll receive some more information by email on how you can keep connected to our content and views. Today, we're going to focus on two things, two investment opportunities we're seeing today, one for short-term money and one for your long-term portfolios. You can submit questions through the Q&A feature at the bottom of the screen, and I'll try to answer them at the end of today's session. So what's going on in the markets today? After a rough 2022 that saw a 24% decline in stocks between January and October, and the worst year for U.S. bonds on record, markets ended the year well and have rebounded nicely in 2023. But the environment is not without its concerns. Tightening Fed policy to combat inflation, a hot labor market, which is likely to keep the Fed concerned about inflation and maybe not slow down their rate hikes as much as some market participants are expecting, high financing costs, and a risk of recession. But so far, the market is seeming to focus on the bottom four opportunities. Inflation is down to 3%, and after a tough 2022, stocks are more attractively priced. Bond yields are providing a nice income because they are higher after the multiple rate hikes from the Fed. And you're getting an alternative in your portfolios for the first time in a while with some income. So what should you do as an investor? It does depend on your goals and what bucket of money you're thinking about. I'm a big believer that money should be allocated according to its time horizon and purpose. Short-term money that you need in the next 2 to 3 years should be invested in a way that's exposing it to minimal capital risk. Long-term money should be invested in growth-oriented investments, which sometimes require individual to ignore the short-term risks, like the ones I shared on the previous slide. Because in the long run, those risks shouldn't impact a portfolio that has a time horizon of 15 years or more. And a lot of times, those concerns don't lead to market losses. We can look at this year as a clear example of that. Markets have done very well climbing a wall of worry. Famed investor Peter Lynch once said, "Far more money has been lost by investors in preparing for corrections or anticipating corrections than has been lost in the corrections themselves." And I agree wholeheartedly with this sentiment. But let's start with your short-term money. This is a chart of the Fed funds rate historically and where rates may be going. The point here is that after a sharp increase in rates, expectations are that rate hikes are peaking, according to the FOMC estimates, and the market and the FOMC's long-run projection. And easing monetary policy is bullish for stocks. That's the whole don't fight the Fed mantra. But the deeper point here relates to your short-term money. We've seen anecdotally, and the broader data backs us up, that investors have piled into short-term bonds and money markets to take advantage of what we're seeing in this slide. Short-term yields are high. The 2-year yield right now is currently at 4.874%, and at certain points this year, it was above 5%. And we're seeing money market yields topping 5% currently. As I mentioned, it's a great yield opportunity, but it's likely going to disappear. And if you sit on your 2-year treasuries and reinvest them when they mature, you have a good chance of getting less yield than what you are now. And the money market yield that has been increasing over time to get to 5% will also likely to be lower at some point. So with your short-term money, you're facing an asymmetric bet, and you need to take steps to improve your long-term odds. We believe the return profile out to the 5-year point in fixed income looks attractive today. If we're not at the end of the rate hike cycle, we're getting there. So let's stress test a 5-year treasury yield held for 1 year starting in June and look at what will happen with different rate outcomes. If rates remain steady, the total return will be approximately 4%. That's the yield. If all relevant rates along the yield curve decline by 1%, the total return will be 8.4%. If rates rise by 1%, you're looking at a loss of less than 0.5%. So if rates go up from here, it likely won't be much, so you're limiting the downside. If rates go down from here, you benefit from current yields plus rising bond prices. So locking in yields now protects you from reinvestment rate risk in the future with your short-term fixed income. So specifically, what solutions are available for investors to confront this environment? One, which we haven't fully addressed yet, is whether your short-term money really is short-term money. The presumption is that the conservative portion of your portfolio is appropriately invested based on the time horizon guidelines that I shared on slide 3. But I know that's not always the case. People sometimes hold lots of cash because they're not comfortable with the stock market or confident that they have the right long-term investment strategy. Build one and get that cash invested appropriately. These yields will not be here forever. 2, shift some of your cash into bonds and not just the short-term stuff, which we covered already. Which leads to point 3. You can build a bond ladder where you take advantage of these higher yields now and buy bonds of different maturity, again, at higher yields than you're likely to see when rates come down. You'll give up some of the yield you're seeing now for higher yield over the life of the portfolio that you build. Now, let's look at your long-term money and specifically incorporating international stocks into your portfolio and building a global investment approach. This would still have the majority of your stock portfolio in the US, just not all of it. Admittedly, this might be hard for you to do if you're focused on how the US has done lately relative to international markets. For a recent 14-year stretch, the US has been the best place to invest globally. So why am I talking about building a global portfolio to target your long-term growth needs? Over the past 50 years, we've seen significant runs of relative outperformance for US versus international stocks. Simply put, they've taken turns outperforming as measured here for the US in gray and international stocks in purple. Most recently, it's been the US, as I've mentioned, with the cumulative outperformance showing one of the largest mountain peaks, but not the largest if you look at the 299% outperformance for international stocks in the 80s during those years when the US was fighting high inflation by increasing interest rates. More recently, after the 1990s, from the dot-com crash to the financial crisis, international stocks outperformed in a decade where the S&P lost 9%. That was the 2000 to 2010 so-called lost decade. So how likely are we to see international stocks outperform from here? We've already started to see a move in this direction over the last 18 months, and the conditions are present for a stretch where international stocks do well as a key asset class in a diversified portfolio. US stocks are more expensive than non-US stocks, and more importantly, more expensive than their 20-year average, while international equities are cheaper than they have been. This is what's on this slide here. The US stock 20-year average PE ratio is 15.5. Right now, they're trading at 18.7. And then on the international side, cheaper valuations, 12.7 versus 18.7, but also more importantly, or just as importantly, trading a little bit cheaper than their long-term average. Thoughtful allocators build resilient portfolios for a range of possible outcomes. A non-US allocation to stocks is an important element for risk management, and over the long run, it's our expectation that it'll increase portfolio risk-adjusted returns. The global stock market's about 60% US, 40% international. That's a great starting point. Incorporating international equities, building a global portfolio, still the bulk of your returns will come from the US, but you are adding an asset class that historically has taken turns outperforming the US stock market. So Heritage Solutions, again, globally diversify your portfolio. You can't just chase performance and expect trends to continue. You do have to pay attention to valuations. What you pay for stocks matters in the long run, just like what you pay for a house or any other investment. Stay disciplined by being informed. In our follow-up email, as I mentioned, we'll share a recording of this video and how you can keep connected to our content and views. So to summarize, our takeaways are, on the fixed income side, you need to protect yourself from reinvestment rate risk. These higher yields that you're seeing now in money markets and two-year treasuries shouldn't last forever. If rates come down, which the market is expecting, the FOMC is signaling, those yields will be lower and your money markets won't be returning 5% anymore. And your two-year treasuries, when you go to reinvest them, won't be getting 2%. So how do you protect yourself from reinvestment rate risk? A, get that money market cash invested. If it's longer term in nature, put it in a longer term portfolio. B, make sure that you are looking out the yield curve a little bit and sacrificing some short-term yield to build a laddered bond portfolio that I said long-term earlier, but over the short to midterm should do better than reinvesting your two-year treasuries and rolling them. That's that laddered fixed income portfolio where appropriate. And just be proactive about your asset allocation adjustments in any market environment, but particularly one as dynamic and unique as what we're facing today. On the stock side, it is time to abandon your home country bias with a healthy allocation to international stocks. Build that globally diversified portfolio, incorporate developed international emerging markets. Don't just look at the US, more specifically, don't just look at the S&P 500, which is one segment of US stocks. Focus on valuations. There are opportunity sets that are cheaper than what we're seeing in the US large cap stock market. Stay disciplined, stay informed. As always, work with an advisor to make sure that your risk profile is appropriately captured. You understand your time horizon, the portfolio that you've built is connected to your financial plan, and that you're taking advantage of opportunities in current market environments. Thank you again for joining us. If there's anything we can do to help you with your portfolio or wealth management needs, please contact me, and hopefully you find the resources we'll continue to share useful. You'll also receive a short survey to help us make these webinars better for you. Thanks again. Have a great summer.